Hello, welcome to Edubbey dynamic page. Today, let us look at stablecoins and their diverse use cases in the cryptocurrency space. 1. Introduction. Ensuring stability, stablecoins are a class of cryptocurrencies designed to minimize price volatility, often by pegging their value to external assets such as fiat currencies, commodities, or algorithmic formulas. This stability makes them invaluable for a wide range of applications within the cryptocurrency ecosystem. 2. Facilitating transactions. Cross-border payments. Stablecoins enable efficient and low-cost cross-border transactions, reducing the reliance on traditional banking systems and providing a faster alternative for remittances and international transfers. Merchant payments. Businesses can accept stablecoins as payment for goods and services, leveraging their stability to avoid exposure to the price fluctuations commonly associated with traditional cryptocurrencies like Bitcoin or Ethereum. 3. Hedging against volatility. Risk management. Traders and investors use stablecoins as a safe haven during periods of market volatility, allowing them to quickly move funds out of volatile assets and mitigate potential losses. Stable value preservation. Holding stablecoins helps individuals and businesses preserve the value of their assets during times of market uncertainty, ensuring stability in the face of fluctuating cryptocurrency prices. 4. Decentralized finance, DeFi, applications. Liquidity provision. Stablecoins serve as the backbone of many DeFi protocols, providing liquidity for lending, borrowing, decentralized exchanges, DEXs, and other financial services within the decentralized ecosystem. Yield farming and staking. DeFi users leverage stablecoins to participate in yield farming, liquidity mining, and staking activities, earning passive income on their cryptocurrency holdings while maintaining stability. 5. Tokenization of assets. Asset tokenization. Stablecoins facilitate the tokenization of real-world assets, such as real estate, commodities, and securities, making them more accessible, divisible, and transferable on blockchain platforms. Fractional ownership. Asset tokenization using stablecoins allows investors to own fractional shares of high-value assets, reducing barriers to entry and enabling broader participation in investment opportunities. 6. Use in smart contracts. Smart contract settlements. Stablecoins are commonly used as the native currency for executing smart contracts, enabling automated and programmable transactions with predetermined conditions and outcomes. Decentralized applications. dApps. Stablecoins power various decentralized applications, including prediction markets, decentralized exchanges, DEXs, lending platforms, and decentralized autonomous organizations, DAOs, facilitating seamless interactions within the decentralized ecosystem. 7. Regulatory compliance. Compliance standards. Some stablecoins adhere to regulatory standards and undergo regular audits to ensure transparency, stability, and compliance with legal requirements, fostering trust and confidence among users and regulatory authorities. 8. Evolving landscape. Technological innovations. The stablecoin landscape continues to evolve with the emergence of new models, such as algorithmic stablecoins and hybrid approaches, aiming to enhance stability, scalability, and decentralization. Integration with central bank digital currencies, CBDCs. Collaboration between stablecoin projects and central banks may lead to the integration of CBDCs with existing stablecoin infrastructure, further expanding their use cases and adoption in mainstream finance. 9. Conclusion. Stablecoins play a pivotal role in the cryptocurrency space, offering stability, liquidity, and versatility for users across diverse use cases. Whether used for payments, investments, DeFi applications, or asset tokenization, stablecoins continue to drive innovation and foster financial inclusion in the digital economy.